Today we are going to discuss another aspect of bank management, that is credit risk and interest rate risk. So first let's define what is a credit risk. This is the risk due to adverse selection and moral hazard. Remember we discussed about this concept adverse selection and moral hazard, which arises when banks give out loans. So adverse selection happens before the loan is given, which means that how do you ensure that people who are not in dire situations are coming to borrow money? Think about a credit card with 30% interest rate. Who typically end up paying 30% interest rate? People who simply don't have money, or who don't have other avenues to borrow. That means they are by definition high risk people, and that's adverse selection. What is moral hazard? Moral hazard happens after the event, like insurances or in a bank loan. If somebody takes out the money, how do you ensure that that person will pay back the money, or what incentive that person has? In the case of credit card, if somebody doesn't pay back the money, obviously that person will not be able to carry out their, or will not be able to hold their credit card in future. So these are the things that bank managers needs to control for. How they to control these things? One is by screening. That means they check your credit history, they check your background to make sure that you are a legitimate borrowers. They also have specialization in lending. So often bank managers are very specialized individuals with very specialized skills to figure out who are the right people they can lend money to. Also, they ensure monitoring, enforcement, or restrictive covenants. That means these are rules and regulations. Often many banks rely on long-term customer relationships, like especially federal credit unions or credit unions locally. These are local banks, and they kind of like make sure that they maintain good long-term customer relationships, and they make it more personalized banking. Then there are loan commitments. Often banks commit that if somebody pays back the money on time, they will get more loans. These are line of credit that keep it open. Often they ask for collaterals or compensating balances like mortgages. When you're taking out a mortgage, basically that your home is owned by the bank till you pay back the mortgage. Or if you're taking out a car loan, your car is owned by the bank till you pay back the loan. Finally, they also engage in credit rationing. That means if the credit is in crunch, they try to ration it into different individuals to spread the risk. Another aspect of risk is the interest rate risk. This is the riskiness of earnings and returns on bank assets that result from interest rate change. Just to give an example, suppose you are taking out a mortgage, and mortgage can be a fixed rate mortgage and an adjustable rate mortgage. Let's say you are taking out a fixed rate mortgage. Suppose you get a mortgage on 4%. What if after 10 years the interest rate goes up to 8%? In that case, the bank loses money because they are just receiving 4% from you, but they have to pay a higher interest on their own borrowings. So this is a risk for the bank, and they try to curtail this risk in different ways. Let's try to understand this, how they can do it. Especially, we'll talk about the interest rate risk. So this is a balance sheet of a First National Bank with the assets and the liabilities. And you can see that there are fixed rate assets and there are fixed rate liabilities, and there are rate sensitive liabilities and rate sensitive assets. What is a fixed rate liabilities? What is fixed rate? The rate that does not change no matter what the market condition is. Whereas rate sensitive liabilities, where interest rate can change based on the market situation. So if a bank has more rate sensitive liabilities than assets, a rise in interest rates will reduce bank profits, and a decline in interest rate will raise bank's profit. So in this case, you can see this bank has $20 million in rate sensitive assets and 80 million on fixed interest assets. On the other hand, liabilities, they have 50 million on rate sensitive and 50 million on fixed rate. So for some reason, if interest rate increases, that means this bank has to pay higher interest rate on this rate sensitive liabilities, but they have only $20 million on rate sensitive assets. So which essentially means that bank is going to lose money. On the other hand, if interest rate declines, banks are going to make profit. So often what banks do, they engage in something called gap analysis to take care of this interest rate risk. So sensitivity of bank profits to change interest rate can be measured by a gap analysis. And what is a gap analysis? This is the change in bank profit should be equal to rate sensitive assets minus rate sensitive liabilities per times the change in interest rate. So this gap analysis can help you to have a measure of how changes in the interest rate can affect banks' exposure to interest rate risk.